Welcome, ladies and gentlemen. Thank you for joining the MMXM Traders Mentorship. Before we dive into all the content, let's watch this mandatory risk disclaimer. So, first of all, I know this goes without saying, but all credit regarding the concepts themselves go to the inner circle trader, Michael J. Huddleston. The 2022 ICT mentorship is a core understanding and is not taught in this mentorship. However, it is a prerequisite. So if you haven't studied the 2022 ICT mentorship, do so first. So over here we got a overview of all the topics we're going to cover. First of all, we have the core concepts. These are foundational to understanding the trading models, and we're going to cover all these topics in the next lessons. After we've covered those core concepts, we're going to go to market maker models, how to use time frame alignment, how to use mitigation blocks, and how to actually trade those market maker models. And we're going to talk about the silver bullet, of course. After that, we're going to go to top-down analysis. We're going to be talking about long-term perspective, intermediate term perspective, and short-term perspective, which includes a New York session bread and butter model. And then at the end, we're putting it all together. At the end of the course, we're going to be talking about models and risk management. So we're going to be talking about a universal model, which is applicable on all time frames. Then a highly requested Asian session model, which is a hidden gem. And then at the end, we're going to be talking about passing funded accounts and how to retain them. So let's start off our first lesson about the power of three, which is the open high low close and the open low high close of a candle. Now, what is open high low close and open low high close? We also call this the power of three, right? So accumulation, manipulation, distribution of a certain type of candle. Understanding the open high low close or the open low high close of a candle is crucial in everything from daily bias to entries. It's a foundational understanding to my trading, and the concept is fairly simple yet highly effective. We all know the daily candle opens up at 5 p.m. EST and closes at 5 p.m. EST. However, we are going to use this understanding from 12 a.m. EST to 12 a.m. EST, which is the true day open. And we call it true day open because this is where the algorithm starts its true day, right? So we're going to be talking about 5 candle formations. We're going to be talking about a bullish candle, a bullish reversal candle, a bearish candle, a bearish reversal candle, and then at the end about a consolidation candle, which is indecisional. Right, so over here we've got a bullish candle and a bullish reversal candle. So a bullish candle is a open low high close, right? Let's outline that over here because we open up the day over here, make a low, continue to expand during the day, creating the high of the day, and then closing out eventually. Now, most of the time when we have these types of candles, London session or London kill zone creates low of the day, and then we expand higher during London and have a New York retracement into a continuation. And then with a bullish reversal, we have a longer wick on the bottom, right? So we have a open, and this longer wick on the bottom can be comprised of a sell side liquidity run on the higher time frame, thus having a reversal and then continuing expanding up higher and closing at the end of the day. So over here we've got two bearish candles, right? We've got that bearish candle and a bearish reversal candle. A bearish candle is a open high, low close, right? So over here we open up, we create high of the day, expand lower during the day, and eventually close out the day down here, thus having a bearish candle. Now again, just like with the bullish candles, the high of the day can be formed during London session most of the time, expanding and having a New York continuation to close out the day bearish. With a bearish reversal candle, we can see again we have a longer wick on the top this time. This longer wick can be a buy stop rate, or we can hit a higher time frame bearish premium array, right? Like a higher time frame fair value gap or order block, causing a reversal for the day, continuing down lower and expanding lower until we close out the day bearish. And finally, that indecisional candle. The name already says it, right? The candle has no idea where it wants to go, leaving a relative equal top wick and a relative equal lower wick, and looks kind of like a doji, right? Right, so over here we've got a British pound US dollar daily chart. We've got outlined our premium and discount levels, right? From this discount low into this discount high. We can see these candles forming what up on top of this? Buy stops, right? And then what do we have over here? We've got a bullish order block, right? So when we're looking at a bullish candle, we're seeing a low created over here, expansion higher, taking out those buy stops, and eventually closing out the day bullish. But how does that look like on a intraday chart? We've got a intraday chart for the British pound and the US dollar, 15-minute chart, right? We've got that higher time frame POI over here, that bullish order block. Now, where do we create low of the day? Below that New York midnight open price, right? So let's outline that over here. Draw out that New York midnight opening price, 12 a.m. EST, right? Low of the day is being formed down here during London session. A lot of times we form low of the day during London session, and that makes trading New York a little bit easier, and I will explain later in this mentorship why. Over here we got that daily candle, right? We open up, create a lower wick, and then expand for the rest of the day with a bullish daily candle. Low of the day London session, New York retracement into continuation until we reach that buy side liquidity target and closing out the day over here, leaving this as a bullish candle. Over here we've got a Euro USD daily chart, right? Where is our discount and premium levels? We go from this low until this high, right? 50% level is in discount. Now over here, we know if we're dropping lower and lower and lower, we're going into discount levels. And are we hitting a higher time frame PDRA? Yes, we've got that daily fair value gap, right? So we're going to be talking about a bullish reversal candle right now, and we can already see it's forming down here. And why are we reversing? Because we took out sell side liquidity, right? And then we're hitting a higher time frame discount array. How does that look like on a intraday chart? Again, we have a 15-minute chart for Euro USD. We're hitting that higher time frame POI, right? We took out all those sell side liquidity and outline this with more annotations. Again, always outline your New York midnight opening price, right? That is the true day open of the algorithm. We want to be buyers below this line and we want to be sellers ideally above this line. So over here, we've got an indecisional London session, right? Probably some high impact news later in the day, could be possible. With New York session, we drop lower, creating low of the day in New York. We run all that sell side liquidity and hitting a higher time frame PD array, right? That discount fair value gap, and then having a New York reversal profile for today. And you can see this longer wick because we opened over here, right? And actually, if we take a daily candle, we open at 5 p.m. But that longer wick is because we dive deep down below that New York midnight open line and then closing out the day higher up. So leaving this longer wick, thus having a bullish reversal day. Right, over here we've got a Euro USD daily chart. We've got an old high up here, external range liquidity buy stops over here have been purged, and then after we run buy side over here, it's likely that we have a bearish day afterwards to fill up an imbalance, for instance this imbalance down here. So how does that look like on a intraday chart? So we got this Euro USD 15-minute chart, right? We ran buy stops above this red line, right? So we are having a bearish day afterwards. So how does that look like with more annotations? High of the day during London session, right? Most of the time, London session creates high or low of the day before a higher time frame PY has been hit, right? So draw out your daily opening price over here. We see we trade and accumulate sell stops above here, taking out these buy stops. And you can see on a daily candle that looks something like this. An upper wick has been formed and the rest of the day will expand lower and lower and lower. During New York, we have a retracement into premium levels, and then we continue down lower until we reach our closing price, forming this daily bearish candle. Now let's talk about a bearish reversal candle, right? So why does it reverse? Most of the time we hit a higher time frame PDRA or we run buy stops or sell stops, right? So in this occasion, we've got these buy stops up here being ran, and then we see this longer wick down and closing the day out bearish. So how does that look like on a 15-minute chart, a intraday chart, right? As always, draw out your New York midnight opening line, right, over here. Draw it out in time all the way to the right for the close of the day. And then with this longer wick on top, we need to have a expansion higher first, right? So we're expanding higher first, having a New York session reversal profile. We run buy stops on our higher time frame and then start to decline after, and then closing out the day over here, forming this bearish candle. So think about it, right? Accumulation, manipulation up higher into those buy stops, and then distribution lower. So that's the power of three of a daily candle. Now let's talk about a consolidation candle or an indecisional candle, right? So the market obviously has to be in a consolidation and the market has no clue where it wants to go next, thus creating a indecisional candle. So how does that look like on a intraday chart? You can already see it when we draw out that New York midnight opening price. It's just straight up, up, down, up, down, up, down, right? So we're creating a high of the day, going back to that New York midnight opening price, creating a lower today, and then just keep hanging around that New York midnight opening price. And this is an indication too of a consolidation day. And you can also say it's kind of a seek and destroy profile because we just run buy stops and sell stops and returning back into the range. And then on a daily candle, it looks something like this as an indecisional candle. Now that we went over our first lesson about power of three, let's move on to the second lesson, which is about failure swings, low resistance liquidity. Now, first of all, what is a failure swing? A failure swing is a swing high that fails to take out another swing high, or a swing low that fails to take out another swing low. So this is low resistance liquidity, and we want to see this form on the opposing side of our structure. So for instance, when we are bullish, we want to see a bearish failure swing. A bearish failure swing is a high that fails to take out a previous high. And when we are bearish, we want to see a bullish failure swing, and a bullish failure swing is a low that fails to take out a previous low. And the market will usually go through opposing failure swings with ease, like a hot knife cutting through butter. Now we covered low resistance liquidity. Let's talk about high resistance liquidity. And we want to see this form on the side of our structure. So a low that ran a previous low and rejected is a high resistance low, and a high that ran a previous high and then rejects is a high resistance high. And we'll use this logic on all time frames. So over here we got a crude depiction of a market maker buy model. We've got our drawn liquidity up here, our structure, and our discount array. Now think about where we want to see those failure swings form, right? When we are bullish, we want to see those bearish failure swings, which is a high that fails to take out another high, right? So how does that look like? Over here, we've got multiple failure swings, right? We have a high over here, which this high fails to take out. Then over here, we've got this little trend line going on, which is a set of failure swings, right? So this high fails to take out this high, and this high over here fails to take out this high. And down here, we've got even more, right? So high, lower high, and even a lower high. So all failure swings around here. Now, once we hit that discount array, and we've got a low formed over here, we want to be targeting those failure swings as our draw on liquidity. And why is that our draw on liquidity? This is low resistance liquidity, right? So we always want to go for that low resistance liquidity. Now, what do we want to see form on our side of the structure is that high resistance liquidity, right? So we know it's rejecting that low and we want to go bullish, so we don't want to see those lows ran again. But how does that look like? So over here we got that high resistance low, right? Because we run that previous low and then reject immediately. So this is a good confirmation that we are heading into bullish order flow. I always say high resistance liquidity runs happen on the opposing side of our order flow. So once we are bullish, every low that gets ran and rejected is probably a high resistance liquidity run, and the market will struggle to go below those lows when we are bullish. Now once we are bullish again from the discount array, we want to target those failure swings, right? That low resistance liquidity. And once we're in discount, we want to draw into premium, right? So once these failure swings are in discount still, that's even better because we want to draw into premium. And if we have that low resistance liquidity in our discount range already, then it's even better to draw into premium and take out that low resistance liquidity. So over here we got the inverse, right? This is a market maker sell model. So we've got our premium array up here and our draw on liquidity again down here. Now, what do we want to focus on, right? We want to focus on that low resistance liquidity. And where is that forming? Again, those failure swings, right? Those low that fails to take out another low. And we've got those over here. We've got again a little trend line down here, right? Multiple lows which fail to take out the previous low, even down here at our draw on liquidity and over here. Now once we hit that higher time frame premium array, right, we want to see that smart money reversal happen, so that change in order flow, but we want to see a high resistance liquidity run first, so we know that's on our side of the structure and confirms our order flow. So how does that look like, right? We have this high which gets ran and then rejects immediately, and if that happens, we have again a good confirmation we're going to go in bearish order flow. Now we can see all these lows, these failure swings, right, and they are all still in premium, which makes it even better if we want to draw at least into discount and eventually the target down lower. Now over here we've got another high resistance liquidity run and then rejects immediately, right? So again, on our side of the structure, we want to see those high resistance liquidity runs happen. So we know these highs are probably going to stay intact and we're going to continue down in our draw on liquidity, right? Those failure swings which we have down here, which are still in premium over here. And then we draw back down into discount levels, taking all those low resistance liquidity lows down here and also down here eventually until we reach that draw on liquidity. So over here we've got a E-mini S&P 500 futures chart. Now let's look where is the discount and where is the premium levels. We've got this low down here for our discount. We've got this high up here for our premium levels, right? And now think about that low resistance again, right? Where are the failure swings forming? We've got those failure swings down here, right? So this is low resistance liquidity, and this is a nice target where we can draw into. So notice how these failure swings are in premium, right? And once we go from premium into discount and those failure swings are still in premium, we've got that engineered liquidity down here, right? Those failure swings, and it will cut through butter like a hot knife, right? Back into discount over here, which we can see that daily discount fair value gap, which was the draw on liquidity after we draw into bearish order flow. So low resistance liquidity up here has been liquidated and we hit that discount fair value gap in discount, right? So how does that look like on an intraday chart for the E-mini S&P 500? We got that 1 hour chart over here, right? So think back about that market maker buy model, that crude depiction we covered earlier. This is the same kind of schematic, only with candlesticks. We've got our draw on liquidity on the highs, right? And then our higher time frame discount array, which in this case is that daily discount fair value gap. Now over here we got that high resistance liquidity run, right, against order flow, right? So it rejects that low immediately and starts to go into bullish order flow. Now notice where are the failure swings, right? We've got all these failure swings up here, which is low resistance liquidity. Now also notice how this is still in discount levels, right? Because the premium is about around here and we want to move up into that draw on liquidity, which is up here, and then target all that low resistance liquidity, all those failure swings up here, and then eventually up here on a draw on liquidity. So over here we've got our Euro USD monthly chart, right? Let's see where our premium and discount levels are. So from this swing high up here into this swing low down here, we've got our whole dealing range. So everything up here is in premium, everything down here is in discount. So what did we hit recently? Did we hit a higher time frame PD array? we've got this monthly premium fair value gap, right? So that's a perfect area where we can reject from, and on the lower time frame we can scout for an opportunity to get into a sell. So let's go to the daily chart. So over here we got that Euro USD daily chart, and remember we hit that higher time frame bearish array, right? That monthly premium fair value gap. So over here we've got some nice structure, right? What do we want to see when we want to sell? We want to see a high resistance liquidity run, which confirms we are going into bearish order flow, right? So how does that look like? So over here we've got that high resistance liquidity run, right? So it's a swing high that takes out another swing high and then immediately rejects price action. And we can see over here it fails to take out this high once again. So it starts to trade lower and lower and lower. Now we want to target that low resistance liquidity, right? So where is that forming? Over here we've got all these lows, right, which are forming, which is a failure swing. Again over here, failing to take out these lows and these lows. And over here we've got some relative equal lows. So that's a very good to draw on liquidity, and we call that low resistance liquidity. Right now, where does a opportunity lie to go into these lows, right? We're scouting for a premium array once again. So what is available on the chart right now? We've got that volume imbalance up here, right? So that's also a good area to take a sell from, and you can actually see how willing price action is to go through those low resistance liquidity lows, those failure swings, right? So you can see here price action goes down with ease, right? And that's the whole point of that low resistance liquidity. Let's go on to our third lesson for this mentorship. It's going to be about previous days highs and lows. Previous days highs and lows. That will be the easiest draw on liquidity for you. Think about it. Every single day you can see the daily candle reaching for previous daily high or the previous daily low. This is the easiest liquidity pool in the market side. There is rarely a inside bar, as we call it, and we'll show you on the next chart how that looks like. But in bullish order flow, the market will always seek buy side liquidity above previous daily highs, and in bearish order flow, obviously the market will seek sell side liquidity below previous day's lows. Previous day's highs and lows is one of the foundations to daily bias and the draw on liquidity. It's the easiest liquidity pool the market will attack almost every single day. So now let's look at this next chart. We've got a daily chart for GBP USD. Now we can see a old daily low over here, or sell stops have been liquidated. So our higher time frame target has been hit over here. Now expanding higher and higher and higher. Let's look at all the candles in this chart. Do you see a candle which is an inside bar? I can show you one if I have to look for it. I think this one did not take out the high of the previous day, so this is what we call a inside bar. But look at all the other candles. Almost every candle takes out a previous daily high or a previous daily low. Over here it takes out the high and the low, which is indication for a reversal, but we'll cover that later. Over here we take out the low, over here we take out the low. Again over here both sides has been taken. This one takes the high, this one takes the high, this one takes the low, and so on. So 90% of all these candles takes out a previous daily high or low and will liquidate a daily liquidity pool. Now looking at after we rated those sell stops on the daily time frame, these daily low down here, what is the next target, right? We have an imbalance over here which could be repriced. Then we also have some relative equal highs up here, which is a good draw on liquidity. So now what do we wait for, right? How do we get there? And when do we engage on this? That's a topic for another section, but looking at all those previous daily highs and lows, that will be the easiest draw on liquidity. Outlining these highs over here. These are all buy stops. And remember, we already took out this long-term low down here, right? So over here we've got this smart money reversal, and then look at every previous daily high, right? This previous daily high gets rated, easy. This one gets rated, creating a small wick on the bottom, going up, taking out this high, and then eventually we're breaking structure over here. So buy side liquidity pools are seemingly getting taken out, and we can assume bullish order flow is coming in. Now let's annotate a break of structure right over here. This was the last swing high in this down move, and it got taken out by this big bullish candle. Now this is significant because we already took out this old daily low, right? So remember that if this low was still intact, and let's say this candle and these candles just were slightly above here, you would still be you would still have to think about this low can be rated again, and then if we take out this high, we might just have a high resistance liquidity run, right? So this is important, this low getting rated before we break this structure, so we know there are no orders left on the sell side to return back into. Now with this displacement over here, what do we form? We have a daily fair value gap inside here after a break of structure, and again importantly this sell side rate down here. So this sets up a nice narrative to take buys, and order flow has changed to bullish instead of bearish. Again, outlining previous daily highs, right? Now we hit that discount array, which is a daily fair value gap after that break of structure. So we dip into that, and then we can look to target previous daily highs, right? So this low didn't get rated. We have an inside bar over here. So continuing up, taking out buy stops over here, taking out buy stops, previous daily high over here again, and again we've got this one over here. Now on a intraday chart, which is a 1 hour chart on the British pound against the US dollar, we have that break of structure right here, right, on the daily time frame, and then we have this blue box, which is that daily fair value gap. Again, think about these lows down here. Sell side liquidity has been rated. So after that break of structure, we can assume order flow is going into bullish order flow. So always outline your New York midnight lines, right? 12 a.m. EST, Monday, Tuesday, Wednesday, Thursday, Friday. Now we know where are we in the week, right? Also, Monday trades up, Tuesday trades up, but look at these highs, right? There are kind of relatively equal high, so it could be a buy side liquidity pool. So now we dip back into that daily fair value gap, which is a higher time frame discount array, right? So it makes sense if we break up structure from here. If we do so over here, we're breaking structure up here, rating this short-term low down here, back once again into that daily fair value gap. We also have a tiny little fair value gap down here, and then continue up, and then order flow is good to go into previous daily highs. So buy side liquidity pool over here, buy side liquidity pool over here, over here, over here, and eventually up here. So zooming in a little bit more, outlining that New York midnight price, right? Dipping below New York and reversing, going for previous daily highs. Again, this is key every time. If you trade below the daily or the New York midnight opening price, create a low of the day either in London session or with a New York reversal profile, we can expect previous daily highs to get rated every time. So if you are confident in your analysis that we are in the daily time frame bullish order flow, only look for those previous daily highs and always mark those out too on your chart. So I would say the most essential things to have on your chart is that vertical line to separate the days from 12 a.m. New York time. Draw out that New York midnight price line, and also previous daily highs and previous daily lows, as those are the easiest liquidity pools in the market. Now, how do these candles look like? Let's go to the next slide. Now we can see actually the daily candles look like this, and this is a very good indication we're still in bullish order flow, right? We've got slightly a bullish reversal candle over here, which we covered in the previous lesson with the power of 3, right? A little bit of a longer wick on the bottom, but closing out bullish after, importantly, hitting a daily fair value gap. Next day, also a buy day. Then we are in the next week, which is on Monday, also a buy day. and then you have to think about what time of the week you are in, obviously. But we still got a bearish candle, but order flow is still bullish, right? So you cannot have like 20 bullish candles in a row. There has to be some sort of a retracement or a slow move lower, and then you can have a bearish candle too. But remember, order flow is still bullish. We've got these nice highs over here, right? So even though this candle closed bullish, think about that liquidity pool, which is above market price, which is the previous daily high. Now we got a daily chart on the DXY, or the US dollar currency index. This will be the scenario for a bearish order flow, which will target previous daily lows. Now there is a higher time frame array up here, a premium level which got hit. I assume this is a daily fair value gap going down lower and breaking structure down here. So we've got confirmed sell side of the curve incoming, right? So over here, every time we take out more buy side, so we take out previous daily highs again and again and again until we reach that higher time frame array, right? Now breaking structure lower and returning back into that daily fair value gap. So this is the same what happened on the bullish order flow, which we just covered, but this is on the sell side of the curve. So now we hit that bearish daily fair value gap, and we can see market is targeting every time this previous daily lows. Marking out your previous daily lows again. This one gets taken out, this one gets taken out. This last swing low after that break of structure gets taken out. Again, previous daily low, previous daily low, previous daily low. So very easy liquidity pool to get targeted when you are in bearish order flow. Let's look at this intraday chart, 1 hour chart again. Daily fair value gap, hit, higher time frame, right? Continuing in bearish order flow. Outline your previous daily lows every time. That's the liquidity pool. Trading lower during the week. This is a Friday. Let me outline this New York midnight open price, right? Every time we trade above it and then start to decline. Trade above it, start to decline. Over here, same situation. Trade above New York midnight price, decline. And it goes on and on until every time we take out these previous daily lows. I would say when Asia range is very large, right, then you don't necessarily have to trade above a New York midnight price. But over here, Asia range is every time is quite small and ideal to trade above New York midnight price. So how do the daily candles look like if we utilize this? Again, all bearish candles, right? So most importantly, do we hit a higher time frame array? Yes, we did, right? That daily fair value gap, that bearish daily fair value gap. And then we start to break structure lower, outlining the previous daily lows. Easy draw on liquidity, and all the daily candles will close bearish. Moving on to our next topic, daily swing highs and lows. Daily swing highs and lows. Now, every turning point in the market forms a swing high or low. On a lower time frame, this might seem meaningless. However, if we use a daily chart and we see this form at a key level, and importantly, we also still have a draw on liquidity present, this becomes crucial and we can frame an entire model behind this idea. So over here we got a US dollar index daily chart. Now, first of all, what is a swing low and what is a swing high, right? Over here we see a swing low. With a swing low, you want to have 3 candles next to each other, right? One is higher closed than the middle one, and to the right of it, it should be higher closed than the middle one. So we've got one higher, one lower, one higher, and then we have a swing low. So over here, we've got a swing high, right? So one candle to the left is lower, one in the middle is higher, and to the right of it, it is lower. So anticipating high probability price moves with swing highs and lows. We need to see them form at a key level. So if we are bullish, we want to see a swing low form at a discount array and or after running another swing low, and if we are bearish, we want to see a swing high form at a premium array and or after running another swing high. So the two opportunities using the daily swing highs and lows, and the easiest model you will ever have, is the day after that 3-day swing bar pattern has formed. So we're going to focus on day number 4 after that swing high or low has been formed. We can also focus on 2 days after that 3-day swing bar pattern has formed. So 2 days after that swing high or swing low has formed, or day 5. So once the 3-day swing pattern has formed at a key level, we can look for day 4 to run previous daily high or previous daily low, right? So after that 3-day pattern. Furthermore, if day 4's body, right, the 4th day after that 3-day swing pattern has formed, if that 4th day body's candle closed above bullish or below bearish, right, we can also aim for previous daily high or previous daily low if the draw liquidity is still intact. So then all we have to do is work with the understanding of the open high low close or the open low high close, right? Taught in that first lesson of the mentorship. So this is hands down the easiest model you will ever have. You may not find a high probability trade on one pair every week, but within a basket of a few pairs you will find one high probability trade every single week using this model. All you need is one trade a week to make a living of trading and pass all funded accounts you want. Right, so over here we've got a crude oil futures chart, a daily chart, and again we're gonna focus on that 4th day, right, after that swing pattern has formed. So we can see a swing high form up here, right? We've got another swing high formed up here, and notice how this is formed in a volume imbalance, right? So we've got a premium array over here, and we've got another swing high formed over here, and we're focusing on that 4th day, right? And notice how that 4th day every time almost is a big candle, and it goes into our draw on liquidity. So now after we focus on that 4th day, we're going to use our understanding of that open high low close, or that power of 3, right, from lesson number 1. So this is day number 1 on the daily chart, right? Day number 2 over here, and then day number 3 down here, which forms that swing high on the daily chart. Now, is it in a key level? Yes, it is in a key level, right? We got that daily fair value gap fill, and then we're going to focus on the day after. So day number 4, open high low close, right? So draw out your New York midnight opening price. We want to see a manipulation or accumulation of sell orders above this New York midnight price line, right? How does that look like? Open high low close, right? So this is the daily candle we are anticipating to form. Over here we've got that accumulation of shorts above that midnight opening price, right? Over here, this is what we want to see, and then we got that break of structure lower, right? So day number 4 is the highest probability day to continue down into our draw on liquidity, and we want to see that accumulation above New York midnight, which happens. So we've got that power of 3, right? That open high, and then we're aiming for that low to expand and then close out the day bearish. We're forming a fair value gap, so this is the next premium array where you can frame your trade setup from, and we're anticipating that open high low close to form, right? Day number 4, very important, and eventually we draw down into our draw on liquidity. Right, so over here we've got a Euro British Pound daily chart, right? And now think about that daily swing high or daily swing low again. We want to see that form at a key level, right? So over here we've got that swing low formed, right? Is it happening at a key level? Yes, it is, right? Because we got that daily discount fair value gap. We've got this discount level and that fair value gap formed down here. Now we're going to focus on day number 4, right? That's most high probability to run that previous daily high after that swing low formation has formed. So over here we've got day number 1. We've got day number 2 hitting that daily fair value gap in discount, and then day number 3 forms that swing pattern, right? And now we're gonna focus on day number 4 because that's highly likely to run previous daily high. So we got an easy draw on liquidity, and we're gonna use again our understanding of the power of 3, right? That open, the low, high, close of the candle. So how does that look like on an intraday chart? We've got that Euro British Pound 15-minute chart right now. And again, we're outlining those numbers, right? We've got that daily swing low formed down here. We got day 1, day 2 and day 3. So that's that daily swing low being formed down here at a key level. Now we're going to focus on day number 4 running day 3's high, because that's an easy draw on liquidity, right? And we know we have a swing low formed at the key level, so bullish order flow is very, very likely to occur. Higher time frame, we have the draw on liquidity up here, but first of all, we're going to aim for that day 3 high. So looking for that low resistance liquidity, we want to see those failure swings, right? That's what we want to aim for. We want to see a high resistance liquidity run with our structure. So if we run a low and we reject, then we can look for a setup afterwards, right? So we've got those failure swings up here, low resistance liquidity. We're going to aim for this daily high. Again, using our understanding of the power of 3, that open, low, high, close of the daily candle, we're going to outline our New York midnight. We're going to use our New York midnight opening price, right? We want to see a low form and then continuation up into our drawn liquidity. So the daily candle should look something like this, right? We want to see an open, we want to see a low form, then expansion up higher, and eventually closing the day bullish. So where does the opportunity lie, right? We've got that liquidity rate down here, then price moves up, and in the process of moving up, we have our drawn liquidity up here. In those failure swings, we form a bullish order block and a fair value gap. So this is an opportunity to go long and aim for that high on day number 3 and eventually expanding up higher, going to our drawn liquidity. So over here we've got a US dollar index daily chart. Again, we're looking for a swing low to form at a key level, right? So we've got this bullish order block over here. We outlined that mean threshold also, an important level, and now we can see that swing low pattern formed down here, right? One higher, one lower, and then one higher. And again, we're focusing on day number 4 and day number 5 is if the drawn liquidity is still intact, right? So on day number 4 over here, we're gonna aim for that previous daily high first. Now how does that look like on an intraday chart? We've got this 1 hour chart over here from the dollar index. Again, day number 1, day number 2 and day number 3, right? We want to see that swing low form at a key level on the daily chart, and then we're going to focus on day number 4. So where does the opportunity lie? We want to look for low resistance liquidity, right? So over here we've got pretty much a lot of low resistance liquidity, all these failure swings up here. We're going into buy side of the curve over here. We've got this bullish order block supporting price up here. And eventually on day number 4, we can focus our attention on our entry model and then target day number 3's high and eventually more buy side liquidity in this LR or low resistance liquidity up here. So simply put, we can look for a fair value gap or an order block, and that could be our entry, and then continuing up into the draw on liquidity. The next topic we're going to cover is internal and external range liquidity. This lesson is what's gonna be the turning point for most of you. This is what makes bias easy. You really want to get your notepad out for this one, guys, and understanding the relationship between these types of liquidity will unlock your ability to read price action. Also, very important, backtest as always. I'm going to be talking about time frame alignment. We're talking about monthly levels into a daily structure. We're going to be using weekly levels into a 4-hour structure. We can use a daily level into a 1-hour structure. So price is fractal, right? So understanding external to internal, we can use these different types of levels on the monthly, weekly and daily levels and using their corresponding structure on the daily, 4-hour and 1-hour. The relationship between internal and external range liquidity and how they interact is the key turning point in really understanding where the market is likely to draw to. I consider this lesson one of the most important, if not the most important one in the mentorship. So grab your notepad, guys, make notes and backtest. The understanding you will learn between these two is the foundation to building the anticipatory skills for price movements and understanding where the market is likely to draw to. Now, what is internal and what is external range liquidity? Internal range liquidity, or IRL, is defined by fair value gaps, so imbalances on your chart. External range liquidity is defined by old highs and old lows. When external range liquidity is taken, a fair value gap becomes the next draw on liquidity, and when a fair value gap is tagged, an old low or a old low again. And when a fair value gap is tagged, an old low or an old high, external range liquidity becomes the next draw. Now we have a crude schematic over here on how to see where internal and where external range liquidity is. We've got this move up starting from here. So we have external range over here, which is an old low, right? We move up, going down, 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 taking out that low. So that is external range liquidity, right? Because there's an old low down here. Now, price only does two things, right? It goes to old highs and old lows, or seeks to reprice into imbalances. So in this range where we draw lower from, there was a fair value gap or an imbalance up higher. Price took out external range liquidity. So what is the next thing price will do? Price will draw to internal next, which is that fair value gap. So think about it, when you see a old high or a old low get rated, you want to either look for an imbalance inside that range to get repriced into, right? And then once that gets hit, we can move for the next one, which is external again. Same over here, only reversed, right? We have external range liquidity over here, as in an old high. Price moves lower, forms a swing low, expands up higher, taking out that external range liquidity. In the process of taking out that external range or old high over here, we form an imbalance down here, which could be a fair value gap. Then price moves back into that fair value gap after taking out external range liquidity, right? And then when we hit that internal range, we want to go for external again. As explained earlier, price only does two things. It draws to old highs and old lows, and it rebalances an imbalance. So there's literally nothing else price does. And with that in mind, it becomes very clear after you see old highs or old lows getting rated, what are we going to look for next, right? We're going to look for an imbalance where we can trade into. And let's say we are in bearish order flow and we take out an old low. There's probably a fair value gap in a premium level on that same structure. We can look to trade and buy into that old, after that old low has been rated, we can buy into that fair value gap. And once that fair value gap hits and it respects it, we can look for external range again, right? The flow of the marketplace is that internal range liquidity being tagged will be the catalyst for price to draw to external range liquidity, and vice versa. And external range liquidity being taken is the catalyst for price to draw to internal range. So it's only this, and it repeats as simple as that after time, it repeats like this: external to internal, internal to external. Using this understanding on the monthly, weekly, daily and 4-hour is the key you've all been looking for when it comes to daily bias. All right, we've got a Australian dollar, US dollar monthly chart over here. Now let's look where is the monthly external range liquidity over here, right? So we rate this external range. Now, without going further, where does your eye draw into? You should be looking at a internal range liquidity in the form of a fair value gap, right? So after external gets rated, where do we want to reach into? We can see this imbalance down here, which is a fair value gap, right? So if you looked at this area after we got this external range liquidity rated, you're on the right path. We can see this monthly internal range liquidity in the form of a fair value gap gets tagged. Now, what happens afterwards? Right? Let's look at this from a daily perspective, right? We take out a monthly external range liquidity. Now, using daily structure to frame our setups, what are we going to be waiting for? After this monthly external range liquidity has been taken, we're going to look for a monthly internal range to be the drawn liquidity. We have this outlined down here. Now we need to wait for a little bit of confirmation, as always, right? So we wait for a break of structure. That happens after we rate the monthly external. Break of structure down here, return back into premium, and it continues down into that fair value gap. Example of AUD use the monthly chart. As you can see, external range liquidity defined by the old high gets taken and price starts to trade away from the high. So your eye should immediately go to that bullish fair value gap below market price as the next draw on liquidity. Because external range liquidity being taken is the catalyst for price to draw to internal range liquidity, which is that fair value gap. When we look at the marketplace with this understanding of the relationship between the two, and we blend that with the higher time frame charts, your understanding of price and where it's likely to draw next should really start to materialize. We can see just from this understanding on the relationship between the two being used on a higher time frame monthly chart, we have managed to frame a bearish bias for the whole 2 months. So think about it, right? You can have a clear draw on liquidity for 2 entire months. All right, we've got a GBP AUD weekly chart over here. Again, let's look at it from here. Weekly external range liquidity has been taken. Where is your eye drawing to? Do we see any imbalances down here? Nope. Where do we see an imbalance? Right down here. So with that imbalance being present down here, this fair value gap, your eyes should immediately go there for the next draw on liquidity. External range has been taken. So what are we going to look for next? Internal range. Right? Weekly internal range liquidity over here. And it draws in there perfectly. Now we've hit that weekly internal range liquidity. Think about it, right? External to internal. Now we're in internal. Where are we going to draw into next? Where is your eye going? Right? External range liquidity over here. It's as simple as that. External has been rated over here. We draw back into internal. Internal has been tagged. Where are we going to go? We're going to go to external. It's simple as that. So that weekly external range liquidity, that old high has been liquidated after going into internal. And looking at the daily chart, now we can see how we can frame our bias on the daily, right? So this was the draw on liquidity. We're drawing lower, 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 right? And then hitting that weekly internal range liquidity. So we went from external, remember, back to internal. Now we've hit that internal range liquidity going into a market maker buy model, right? This is the sell side of the curve over here. Then we're going into buy side of the curve over here because we hit a higher time frame discount array, right? It's a fair value gap. So now we're going to reach for external range liquidity. And the first external range liquidity, which is very obvious, is this long wick here, right? So we're going to eye up this liquidity, which is also a break of structure after we hit that higher time frame array. Now, when the market displaces over here, we have internal range liquidity formed, right? So again, we go from external over here. Where do we want to go? We have internal, right? Back into internal. And after we hit that internal, where do we want to go? External again, right? So we have this old high up here, which is external range liquidity. And you might think, well, wait a minute. I thought this was external range liquidity, right? But in this whole bigger range, every swing high or swing low is external range liquidity. And that, remember, internal range liquidity will be that fair value gap we're looking for to mitigate with and continue up. So same case over here, we take out this external range liquidity. Again, where are we gonna go? Do we see any fair value gaps? Yes, we have this one. And we have a fair value gap down here. But why are we not taking this fair value gap? Right? This has something to do with premium and discount. Obviously, if you take this range high to this range low to this range high, this fair value gap is in premium. So it's more likely it will draw into this discount fair value gap, right? So keep that one in mind. Market draws to that internal fair value gap in discount, right? Of this range, swing low to swing high. Continues up again. Where are we gonna go after we take this internal range? Again, it's on repeat, right? External to internal to external to internal, and it keeps going and going. Again, external range liquidity over here after we take that internal range. So we've went from this internal on a higher time frame, right? That weekly internal range liquidity as the fair value gap, and now we're on a daily chart and we can see day after day, we're looking for external to internal to external to internal. Again, back into external, right? Now we've hit that external, that extreme high up here. What do we want to do? We want to go back into an imbalance again, right? There's another imbalance down here in the fair value gap, and it keeps on going into internal and then draws back into external. So literally it's external to external on repeat. Again, external, and then all the annotations together, you can see how this is forming, right? Think about that extreme high. We're going to, and this high, we rated an external range liquidity over here. Remember, so we're drawing into a weekly internal level. Weekly internal level is down here, right? That fair value gap. Now we're looking for a buy program, buy side of the curve. We're going to an external range here, back to internal, to external, to internal, to external, to internal, and so on and so on. Knowing the relationship between the two is what leads us to a high probability daily bias. You can see how many intraday opportunities we just had with the understanding of the relationship between internal and external range liquidity. All right, we've got a USD dollar index daily chart. Again, example after example, and this is what you need to see. You need to train your eyes for external to internal to external, and it will make your reading of bias a lot better. And sometimes you don't know what is the draw on liquidity, but with using external to internal and internal to external, it will make it a little bit easier and, might I say, more accurate. So over here, external range liquidity again, right? What do we do after we take external range liquidity? So what do we do after we hit external range liquidity? Again, we want to go to internal range, right? So where is internal range liquidity? We've got this big fair value gap up here. Price reprices back into that imbalance over here. So we hit that internal range liquidity. What do we want to do after we take internal range liquidity? Go back to external, right? We fill this up. We look for this external range liquidity down here. And we keep declining. We take out this external range. Where are we gonna draw into next? You might have guessed it already. We're going to internal again, right? You can see it draw lower, going back into internal down here. Keep declining, taking out a low. There's no imbalance anymore over here, so price has issues going up way higher than here, and it just keeps declining, taking out this external range liquidity. Now we took external range liquidity. Do we see an imbalance anywhere, right, where we can reprice into? Yes, we have over here. We have this daily fair value gap, internal range liquidity. We've got a British pound Swiss franc daily chart over here. Again, example after example. Keep repeating this. Down here, external range liquidity, old swing low, right? Over here. And might I add, we have a rejection block here, right? This long wicked area over here, which is pretty deep in discount, right? Don't forget about your discount and premium levels, which is this whole range. Right, so we're pretty deep in discount. We rate a swing low, which is external range liquidity. Now where does your eye draw into? Right, we have this candle's low to this candle's high, forming a fair value gap up here. Price draws in there after we take external range liquidity. So now what are we gonna do after we take this internal range liquidity? You've guessed it, we're probably gonna go into external range once again. So looking at a 1 hour chart makes the structure look a little bit easier to read, right? We have a clear sell side of the curve over here, leaving that fair value gap on the daily time frame. After we take out this external range liquidity, we can actually see with 1 hour chart starts to break up and starts to break structure up here, right? Break of structure, return back into discount levels, repricing this internal range liquidity, right? External over here, back to internal, continuing up, taking out external, Where are we going next? Back to internal, right? Fair value gap down here. And then we're gonna go for external again, which is this daily fair value gap. So we went to external on a 1